What's going on, everybody? I hope you're excited. We got Chegg earnings on tap. Actually, they've already, been served, but that's okay. You see the result, the stock's up 7.8%. So a pretty good reaction, obviously. We're going to dig into these earnings and see what that's about. Obviously, if you look at the analyst estimates, we saw a little bit of negativity. They were expected to decline revenue this year. My presumption is if they actually did, they likely would not be up right now. Just being honest with how the market's trading. But you do have to consider that if you look at this stock, it is down massively from its highs. It is down 70, really it's over 76% from its highs. A 52-week high of $115 on this stock, right? And right now it's really sitting right next to its 52-week low here at 23. Pretty darn ridiculous if you look at the 1-year chart. This thing has traded down ridiculously so in the last year. It hasn't just been a decline really since the start of the year like a lot of these stocks have. Still adding on to the start of this year though too. So crazy stuff. Let's take a look at these earnings, see what we got. We look and we see Chegg posted a non-GAAP EPS of 38 cents, beats by 7 cents. From a non-GAAP standpoint, obviously good. Curious on the net income because this is a company that has yet to post a full year of profitability. So we'll see what they're able to do in that aspect. So my presumption is, given this number, that they will be posting a profit number, but we'll see. Revenue came in at $207 million, which actually is a nice beat of $12 million, which did mean that they actually grew sales. They grew revenue this quarter. I'm not quite sure why the growth rate slowed so much this quarter. Very curious on what that looks like. But if you look at the full year, I'm pretty sure they still grew by 20+%. So not necessarily like the growth story is done with this stock, but you may see kind of why this stock has reached some, rougher times when you look at performance. This is really, it really was one of the growth darlings, I guess is a fair way to say it. And as growth rates slow, you know that the market kind of leaves you behind, okay? They really do like to leave you behind. It's just kind of how it goes, and your valuation just tends to kind of fall by the wayside given the current market. So as far as guidance, they're expecting revenue between 200 and 205 million, which is above the consensus, so that's a win right there. Big time win. Gross margin between 71 and 72%. It's a very high margin business when all things flow properly, so I do feel pretty good about that. From a profitability standpoint, once they get to the profitable point, which I think they've reached now as of this year, they should be able to grow that profit line pretty significantly in the future. So, for the full year, they're giving full year guidance, which is pretty wild. They're going $830 to $850 million versus an $835 million consensus. So pretty darn good there. Pretty darn good. Yeah, what can I say? And the gross margin line looks good. Adjusted EBITDA 260 to 270 also looks good. Let's look at the press release and compare that, obviously, to what we're seeing for this year, for the full year, 830 to 850. And again, if you look at the full year, they posted a $776 million line. So where does that put us for this year's growth? Well, it puts us, if you look at it, we're talking right around 10%. A little bit less than 10% growth is what they're expecting. So, put into context here, that is kind of why you've seen a pretty big drop in this stock. The valuation's been hammered because of the fact they're not able to post really the massive growth numbers they were posting before. And it's a trend that is slowing quite steadily. So you have to keep that in consideration. Now, does that mean the stock's worthless? It doesn't. I'll say it right there. But it just shows that look, the market takes no prisoners right now. Okay. If you look solely at Q4, obviously, We saw a 1% increase year over year, nothing crazy. Chegg services revenue did grow 6% year over year, which was 90% of the total revenue. Net income line was positive at 24.3 million. Not too bad when you're talking about 1/10 of the revenue line. Not too bad, all things considered. And 4.6 million Chegg services subscribers increased 5%. That's what they're going to have to continue to do, obviously, to show growth. Again, subscriber numbers are pretty big. For the full year, they had 7.8 million, obviously, here. Pretty nice. An increase of 18% year over year, which is kind of where you see this revenue line, where it's at. Net loss, though, darn it, I was incorrect. They didn't quite reach a full year of net income, but they will next year. So next year will be the first profitable year. $1.5 million loss for the year. It's not bad when you talk about full year revenues at $770 million. Not bad at all, especially because they're headed in the right direction. I think that's where I kind of make an exception. You know, I don't like companies that don't make money, but again, they're on the cusp of making money for the full year in 2022. So definitely like to see that. Services revenue is up 29%, or 89% of the total revenue, and you see that kind of shifted here in Q4 to being a little bit lesser of a percentage, and it was a lesser percentage in 2020 as well. So we saw the business outlook, fun stuff there. And for the full year, we saw the business outlook. Nothing crazy. Nothing crazy. They do mention here priorities in 2022 is to expand and improve discoverability. Again, Chegg's a pretty well-known name, but the focus still is going to be getting on new subscribers. That's how they grow. For two, they're investing in international expansion, including the newest and exciting addition of Busu, entering into a $17 billion digital language business. 3, they're going to invest in to grow the skills business, offering more courses. Obviously, that'll help increase the amount of people they bring on. Also, probably increases the price, though. They will add more value to existing customers and new customers through bundling, pricing, and new offerings. And again, what does that look like in terms of profitability? They're talking about a lot of spending here. That's kind of a part of their main focuses here. So as a company that's not really been able to post profit, what does that look like for them? I still feel good that they're able to post profit from here on out, but obviously worth mentioning. And those are obviously just words from the CEO. But we like to take a look at the balance sheet. I think they've got them. That they do, baby. Look at the balance sheet, see where the company's at. You look at total current assets. Full year comparison is beautiful for me. $1.6 billion right now, sitting in total current assets compared to 1.1 of just a year ago. Big increase in the cash position, as you can see. Total assets in general at 2.9 to 2.2. Most of it was due to an increase, obviously, here in the cash position. But you see long-term investments grew by quite a hefty margin too, $200 million over the last year. Current liabilities at $114 million compared to $109. Not much of a big growth there, but total liabilities quite high on this company because of offerings that they've done. You see these convertible senior notes at $1.6 billion, and obviously those mature spread out throughout the next couple of years, so you have to consider that through 2025. So that, all things considered, it's quite a bit. Total liabilities at 1.8 compared to 1.6. Didn't grow by nearly as much as they grew assets though over last year, so that's a positive. Obviously, they'll be coming into a bit of a rough time when they have to actually, when these do convert, but now that they're starting the trend of profitability, it'll be a lot easier for them. Shareholder equity grew quite a bit, $1.1 billion compared to $609 million only of just a year ago. So the balance sheet nearly doubled the equity, looking pretty good. So where do I find this stock? Look, it's hard to say. from a 4 PE ratio standpoint, this is a company, it's still trading expensive because the fact that they're not able to consistently post profit, we don't know what that looks like for them necessarily. But a market cap of $4 billion, look, it's pretty darn cheap. I mean, I can't lie to you. This is a company that this year is going to be posting supposedly $850 million potentially, and at just around 4 times that value, 4 to 5 times when you look at the low end of their estimate. 4 to 5 times that value is pretty cheap for the stock right now. I mean, it's trading darn cheap. Now, what does the future look like for the growth of Chegg stock? That one I literally can't peg down. We're at a time in which I could not tell you the short-term response for Chegg. Obviously, we see a nice reaction here, 6+% up in the pre-market so far. But then you have to consider the fact that this is a growth darling that has actually just admitted that they're going to be growing less than 10%. They're not even going to be growing double digits, and it's still, frankly, a company that's in its infancy. When you're talking about not even $1 billion annualized revenue here, and not for a while, this is a company still in its infancy, and they're not posting the massive growth numbers while still not posting profit. That really, in my opinion, hurts the valuation. I mean, it hurts where this thing should be trading at. But the market's so irrational, you just don't know right now which it's going to love. You don't know what stock it's going to love. I still don't like Chegg in the short term, even at 29, right next to its 52-week low. I don't like it in the short term, and I absolutely will accept being wrong on that if I am. I don't think it's valued expensive. I'll throw that out right there. I just don't like how big investors might take this report and guidance, frankly. I just don't know if it'll be sustained. So that's what I got for you, and I hope you have a great day.